have this conversation with me is Nigel Green, CEO of deVere Group. Nigel, thank you for joining me. It really is a great time to pause due to the bank crisis that's happening, and we're looking to the Fed to say, can you do something to make this journey easier for the markets? What are your thoughts on how the Fed is continuing to control inflation?
I think they've got a really tough decision to make this week. We've seen, obviously, with the banking crisis, that has had an effect on the markets, and there really is a lack of trust. And the Fed, in particular, has been questioned on its decisions in the past. So right now, they need to stop inflation. That's a core issue. But also, they've got a banking crisis. So unless they can lift confidence, they really are going to back down the road a bigger problem. So right now, they want to try and stop that problem. And this week is the opportunity to try and do that.
Does the market influence the Fed, or does the Fed completely close themselves off and just have a view of all the different data points they need to do? And do they make a call on what will ultimately grow the market, the economy of the U.S., or do you believe that they are sometimes able to concede and give bankers and people in the finance industry a little bit of a break, even during such difficult times?
I think we've got a really difficult situation now because it's both of those things. I mean, first of all, you can't have a banking crisis around the world. So if trust goes as it has, then that's number one. They've really got to make sure that the economy continues to work, and that means banks continue to work. But then secondly, it's also a major issue. Inflation, of course, affects many people. People often that are struggling, and we see around the world that you get social unrest when you get high inflation and people struggling to make ends meet. So inflation is also a massive issue, and they won't hesitate to really make sure that they attack that problem of inflation. So two big issues, and they need to attack both of them, which of course is a fine balance.
But also there's the issue of them being responsible for other markets, whether it be SA. I mean, they don't think about us much, I'm sure. But then there's also the UK and the EU.
Right.
Is that also causing pressure? Because this is contagious. If they can stop it, it means that they save everybody else this pain.
Yes, absolutely. So, I mean, I think you saw it at the weekend with the banks. So, Switzerland's under pressure. But guess what? They're getting a phone call from the US as well saying you've got to sort this out. UK's on the phone too. So, yes, the Fed's concerned about the rest of the world. Number one, always, unfortunately, perhaps for the rest of the world, is that it's got to try and look after America. And that's going to be its main concentration. So, I mean, there's lots of factors here. First of all, they don't want to see the stock market increasing too much. So they don't want too much optimism in there because that could cause even more inflation. So it's a really difficult fine line that they've got themselves in. And perhaps it's the mistakes of the past that really are haunting them and maybe adding more pressure to this next decision, because if you think that people would say they didn't get it right, that's why they're where they are. So guess what? Next decision, they really need to get it right.
But I mean, in all fairness, economics, is not an exact science, is it? So they're not sitting there with a handbook that tells them if they go this way, it's going to have better ramifications for the future. Do we give any due to the fact that this is actually really complex business in a market volatility never seen before and probably not going to be seen again, who knows, in the next 10 years?
Let's hope not again in the next 10 years, right? I mean, I think, first of all, they should have seen it originally. So they said that inflation was temporary. They had all the data. They had lots of stats. So it was an easier decision when inflation first came along. They said it was temporary. They said it was transitory. It fairly obviously wasn't, because you had wage inflation. So they should have acted at that point. And if you go before that, of course, they added so many dollars to their economy, which again has caused this particular problem. You're right, though. Right now, you could be forgiven for saying that they're in a situation where it's difficult to measure. I mean, how much have we seen a dampening of inflation? Are people stopping purchasing goods? Is there pessimism in the global economy and US in particular because they're worried about the banks? I think there is. So I think there's an effect that already has occurred because there's a loss of confidence in the bank. So I think that actually is already dampening the economy. And that puts perhaps less pressure on them to increase interest rates as they would have done. In fact, Goldman Sachs says they actually think that it's going to be a zero rate increase, no increase at all. Whereas most people, I think, including myself, would say it's going to be 0.25, just simply and solely because you do still have this wage inflation, which is causing real inflation.
And I think, who are the major influencers of the decisions that need to take place? Is the Fed completely exempt from being influenced? So is it a solitary business where they look at data and data points, or is there a relationship between the market influencers? And you're so right. As a consumer, there's nothing that you can do. I'm going to do exactly what I want to do. If I'm going to spend and get myself into debt, I'm going to spend and get myself into debt. So as a variable, the consumer is really one that cannot be controlled, can they?
No, and I think that's what we've seen, haven't we? We've seen we've got inflation rising, interest rates rising, and actually people just borrowed more money. So the economy just kept growing, and of course, it wasn't stopping inflation. So you're absolutely right. There's some things that they totally can't control. They would say they have to keep raising it until the consumer is under control. Very, very difficult to do. What pressures do they have? Outside pressures? They're going to tell us they don't have any, but of course they are influenced by lots of people around them, politicians. Ultimately, they're the ones that pick them for their jobs. So they want to create a good impression. But I think right now, trust is the biggest issue. So how can they create trust? Trust in them and their decision making, trust in the banks. I think it's sensible to go with a 0.25% increase and try everything. Every word counts. You get one word wrong. I'm not sure I'd want to be making the speech, but you get one word wrong and it can be misinterpreted by the markets and then the public at large. And of course, that on its own can cause an issue, as we've seen with the Saudi investor who said absolutely no when asked whether he was going to invest more money. Perhaps if he just said no, it wouldn't have caused such an effect on the shares of Credit Suisse.
It really feels like a universe of its own, and everybody's a player, and anybody, as you say, can say the wrong thing that on any other day could have been the right thing to say. So it's definitely not a market we can control. Thank you so much for this conversation.